Here are the top 10 high-yield dividend stocks on my watchlist for January. NextEra Energy with a yield of 2.87%, Mondelez with a yield of 3.16%, Royal Bank of Canada with a yield of 3.42%, Comcast with a yield of 3.32%, Genuine Parts Company with a yield of 3.45%, PNC with a yield of 3.32%, Restaurant Brands with a yield of 3.57%, WEC Energy Group with a yield of 3.79%, Evergy with a yield of 4.34%, and Xcel Energy with a yield of 3.24%. Collectively, these 10 stocks offer an average starting dividend yield of 3.45%, or at least they did at the start of January when I published this list on Seeking Alpha. Based on dividend yield theory, these 10 stocks also appear to be about 20% undervalued relative to their historical dividend yields. They have reasonable payout ratios, averaging out to about 58%. They have grown their dividends at an average rate of 7.68% during the past 5 years. Also, they all have positive 5-year revenue and earnings growth. I've been publishing my top 10 high-yield dividend stock list on Seeking Alpha every month for the last 50 months. So let's take a quick look at the track record to see whether it has worked out well or not. The watchlist currently has a compound annual growth rate of 16.33%, which in my opinion is pretty phenomenal for a high-yield dividend-focused strategy. For perspective, we can take a look at two alternative benchmarks, VYM and SPY. VYM is Vanguard's high dividend ETF, and over the same time period as my watchlist, VYM has achieved a CAGR of 15.58%, which is also a pretty phenomenal long-term rate of return. However, my watchlist has performed better, and on average offers about 1.5 times the starting dividend yield compared to VYM. SPY is an S&P 500 ETF, and it has a CAGR of 16.79%, placing it slightly ahead of my watchlist during the last 50 months. So, my watchlist has performed reasonably well relative to the broad market, and it has offered, on average, more than 3 times the starting dividend yield. If we look at the entire past 50 months, there have been better and worse periods for the watchlist. For example, December of 2024 did not pan out very well. My top 10 list posted a loss of 6.42%, while VYM fell by only 4.58%, and SPY lost just 2.41%. But if we think about the objectives of a solid dividend strategy, short-term total returns are not the primary focus. While we would all love to see the stocks we buy appreciate in value right off the bat, that is not always the reality. Oftentimes, we buy a stock only to see its share price decline. However, if we are willing to purchase a stock at a specific price, and then the price of the stock declines, you should view that as an opportunity rather than a loss, because you have the option to purchase more shares at a lower price. A good dividend strategy should offer you an attractive starting dividend yield. It should deliver inflation-beating dividend growth, and it should also offer you long-term capital appreciation, or in other words, a good total return. I believe my top 10 list has delivered on all of these objectives during the last 50 months. And the primary reason why it has been able to deliver respectable long-term returns is the process I follow to put this list together each month. That process is focused on finding quality companies trading for attractive prices that have the potential to offer reasonable total returns in the long run. I screen the entire stock market for strong companies with a history of growth that currently offer a dividend yield of at least 2.75%. I know many of you may not consider a 2.75% yield to be a high dividend yield, but given that the S&P 500 yields about 1.2% today, and if we consider the S&P 500 to be a good representation of the US stock market, then a 2.75% yield is more than double the market average. And what's more important to me than the actual starting dividend yield is how that yield stacks up against what a given company has paid historically. I like to find stocks that are currently paying a higher yield than they have in the recent past. That's one way to identify potential undervaluation. And by keeping my dividend yield threshold relatively low at 2.75%, I can capture certain great companies that normally offer yields in the high 1% range or low 2% range when they go out of favor and sport a more juicier yield. Let me tell you about a few of the best ideas this top 10 list has produced. The best stock on this watchlist was Broadcom, ticker symbol AVGO, and it first popped up on the list 44 months ago when it paid a yield above 2.75%. Fast forward to today, and Broadcom has grown by 455.69% and pays a yield of just 1.05%. The second best stock from this watch list is Progressive, ticker symbol PGR, that has returned 183.43% over the last 47 months. Number 3 is JP Morgan, ticker symbol JPM, with a total return of 172.68%. Number 4 is Bank of New York Mellon, ticker symbol BK, with a return of 150.55%. And rounding out the top 5, we have Principal Financial Group, ticker symbol PFG, with a total return of 130.16%. All 5 of these stocks popped up on this watchlist in its early days, with Bank of New York Mellon, JP Morgan, and Principal Financial Group being part of the first watchlist 50 months ago. Progressive and Broadcom were also identified almost 4 years ago. And this makes logical sense, because that is how long-term investing works. Returns are supposed to compound and get better over time. So the stocks that have been tracked for the longest time should be the biggest winners. But in addition to tracking the total return, I also track the average monthly return, which is another indicator of whether or not this process is still delivering good ideas. Currently, the stock with the best average monthly return is Discover, that popped up on this list 16 months ago, and it has delivered a 4.36% average monthly return since. Broadcom is the second best stock with a 3.97% average monthly return. Number 3 is CRH plc, that has delivered a 3.29% monthly return over the past 13 months. Number 4 is Goldman Sachs with a 3.26% monthly return over the past 19 months. And number 5 is Anowek with a 2.71% monthly return over the past 21 months. This process isn't ideal, and it has produced a few duds along the way. But like they say, you can't make an omelet without breaking a few eggs. The worst ideas this watchlist has identified are Advanced Auto Parts, that is down 75%, Paramount Global, that is down 59%, Intel, down 49%, UPS, down 33%, and Franklin Resources, down 31%. In total, 90 unique dividend stocks have appeared on the top 10 list over the past 50 months. Out of these 90 stocks, 74 have a positive total return, while 16 have a negative return. The top 10 list isn't meant to be a literal investing strategy, and by that, I mean you shouldn't go out and buy all 10 of the presented stocks. The list's main purpose is to present me with a short list of stocks I can review further. That being said, I prefer to track the performance of the entire watchlist, because it can give me a sense of whether or not this process of identifying stocks is working well or if it isn't. Another way I measure the effectiveness of this strategy is by running a dollar cost averaging buy and hold test. In this test, I simulate the return of dollar cost averaging an equal sum of money into each of the chosen stocks every month they are part of the top 10 list. These positions are left alone and held forever. Out of the 90 stocks that have appeared on this watchlist, 73 would have led to a positive overall return in this test. That's an 81.11% rate of success, which in my opinion is pretty good. I also run a separate test for the stocks that have appeared on the watchlist more frequently. If a buy and hold strategy, as I outlined a moment ago, would have been applied, more capital would have been allocated to these stocks relative to the stocks that appeared in the top 10 list less frequently. Out of the 29 stocks that have appeared on the top 10 list at least 10 times, 25 would have led to positive returns, which is an 86.21% rate of success. So the more frequently selected stocks have led to even more success relative to the top 10 list as a whole. In the Seeking Alpha article, I always highlight the new stocks that pop up on the list. And this month, there were 3 new stocks that were not part of the December 2024 list. They are NextEra Energy, WEC Energy Group, and Xcel Energy. Let's briefly talk about each of them in more detail. At the time I wrote the article, NextEra Energy traded for about $71, and dividend yield theory suggested its fair price was $87. Today, NextEra is trading for an even cheaper price of about $67. Implying that the original 17% undervaluation is likely even higher today. From the dividend yield theory valuation chart, we can see that the stock had a nice recovery in 2024, but faded in the latter months of the year, in turn presenting investors with a slightly more attractive dividend yield. NextEra has typically been a sub 3% yielding stock. Investors had the opportunity to pick up shares with a starting dividend yield of 3.7% in late 2023 and again in early 2024. Then as the share price climbed higher, the dividend yield trended lower, almost touching the 5-year rolling average of 2.37%. More recently, the minor pullback in price has once again pushed the dividend yield towards 3%. And while this isn't as appealing as the 3.7% yield from just a year ago, relative to its long-term history, today's yield is pretty attractive for NextEra Energy. The company has a great track record of increasing its annual dividend payout, with the last 9 years all seeing at least a 10% dividend increase. WEC Energy Group traded for about $94 at the time of the article, and the price is actually relatively unchanged today. And dividend yield theory suggests a fair price for the stock is $104, giving us a potential 9% undervaluation. We can see the share price has climbed higher since about mid-2024, but still remains in the green or attractively valued zone. Looking at the dividend yield history chart, we can see the rolling 5-year average yield for WEC is a little north of 3% today, while the stock has a forward dividend yield of about 3.5%. A better time to buy the stock would have been during the first half of 2024, when it offered a forward dividend yield above 4%. But since we can't go back in time, we have to base our decisions on the information we have today, and the stock does appear to be attractively valued relative to its 5-year history. WEC has a respectable history of dividend growth, with the last 5 years seeing a dividend increase of more than 7%. The company has already announced another increase that will go into effect in 2025, and investors will see a 6.89% dividend increase in 2025 relative to 2024. Xcel Energy at the time of the article traded for about $67, and today its price is closer to $63, so it's a little bit cheaper. Dividend yield theory gave us a fair price of $72, indicating the stock may be attractively valued. Xcel Energy dipped in early 2024, but had a nice recovery in the second half of the year. More recently, there has been a small price correction that has brought the forward dividend yield up a little bit. From the dividend yield history chart, we can see that early 2024 was the best time during the last 5 years to pick up shares of Xcel when it paid a yield above 4%. Towards the end of 2024, the stock's forward dividend yield converged with the rolling 5-year average. As soon as this happened, the yield bounced higher. Like the prior two companies, Xcel Energy has a good history of dividend growth, with at least a 5% annual increase since 2014. The company has not announced the 2025 increase yet, so we'll have to wait and see if the decent pace of dividend growth will continue for another year. If you want to follow this watch list, you can follow me on Seeking Alpha, where I write under the alias Dividend Yield Theorist. I also share this list along with many other lists and analysis on my Patreon. There's a link below if you want to check it out. Paid patrons receive all of the updates earlier than they are published elsewhere, while free patrons get access to the majority of the content a few days later. I also publish a free newsletter, Quality at a Fair Price. If you'd like to check that out, there's a link in the description below. I share a lot of my stock analysis in the newsletter, along with valuation updates for my investable universe. Thank you for watching. If you enjoyed the content, please make sure to like and subscribe. See you next time.